Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. What a run we've had for the equity market. 28 all-time highs on the S&P 500, and the rally just keeps on climbing. Rick Wurster, the president and CEO of Charles Schwab, joins us now to discuss. Welcome to the program, sir. It's good to see you.
Thanks, Jonathan. Nice to be here.
Welcome back, Rick. It's always good to see you. What a year it's been already for 25. Still got 3 or 4 months left. Can you frame for us how engaged your clients have been over the last year?
Our clients are very engaged. Our trading activity this year has generally been about 30% higher than last year. So clients are in the market, they're invested. I've been in about 15 of our retail branches in the last couple of weeks, and I was in Princeton, New Jersey yesterday, and I asked a client how they were feeling. And I think they synthesized what our investors are feeling really well. They said, I'm happy, but I'm nervous. And they're happy because markets are at all-time high. Their balances have never been higher, but they're looking at valuations and wondering, am I going to be okay? So it's a great time because they're looking to us for advice, and they're coming in and they're talking to us and they're hearing from our experts. But it's, overall they're happy because markets are up.
What do you think the dominant anxiety is at the moment? We've been trying to ask this question. Is it the anxiety to get out? Do you have to do some hand-holding? Or is it the fear of missing out? Are they looking to lean in a little bit more aggressively?
I think our clients are generally engaged and invested. So I think it's more, hey, I have more wealth now than I anticipated. Markets have done better than I thought. Do I need to be worried about valuations, and should I be getting out? I think, interestingly, as it relates to the bond market, we're seeing a lot more interest in bonds now because with rates coming down, investors are wondering, do I need to go out the curve? I've been living off my purchase money fund, but the yields on that are coming down. Do I need to go out the curve and lock in higher yields? So that's been a topic of hot debate among our clients as well.
The sort of elusive money on the sidelines that we talk about that's supposed to rush back into everything else, particularly the long end of the yield curve. Is that actually happening?
Well, I think if you look at our clients, the percentage that they keep in either cash or purchase money funds has stayed relatively stable. Now, when the dollar amount has grown because their wealth has grown so significantly with the market increase in the last couple of years. So from a dollar standpoint, there is a lot of cash sitting on the sideline, but at the same time, it's roughly the same percentage that they've always kept because they want it for safety needs or they want it to, they're purchasing a house, whatever it may be. So I don't see a big story around cash sitting on the sidelines at the moment.
Do you notice a really big difference in how your clients trade depending on their age, depending on their generation? For example, older individuals tend to go to mega caps, younger individuals just straight Bitcoin.
Well, we spend a lot of time talking with our younger investors, and we have 35 hours a week of live education and training to try to get investors to think about the difference between an equity and a coin and to make sure they're making the right investment decision for them. I do worry about younger investors, and crypto has been something that's done exceptionally well. But we want to make sure that young investors also know about the power of equities over the long term. And that investing generally is something that you want to do for the long term. Certainly you can trade and take on positions, but you shouldn't expect quick hits all the time. And I think we want to make sure that young investors are aware of that.
But I really appreciate in this country the bias to invest, the bias to act, the bias to take a bet. In the UK, I saw some numbers recently about how much consumers were investing, but how much of it was just going to really, really low yield stuff, like cash funds, stuff like that. There isn't the same bias to invest in equities and risk that I've seen growing up in the UK that exists here. Where do you think that comes from in America, and how do we continue to nurture it?
Well, I think it's great, and not only has it been great, it's getting even better. If you look at millennials, they're 40% more likely to be invested by the age of 21 than Gen Zers. So it's happening with younger investors as well, and we're trying to engage them where they are. We go to YouTube, TikTok, Instagram, and we put out videos about the power of compounding. And we try to get them interested in investing, because if you start young and become an investor, hopefully you'll stick with it and you'll build wealth. It's the single best way to build wealth in our country, is to be an investor. And young people today are embracing it far more than prior generations, which is outstanding to see.
It used to be that all those opportunities were in public markets, that you'd get that blockbuster IPO that you'd want to get exposure to. Now a lot of it's staying private. How are you thinking about offering opportunities in private markets for customers going forward from here? What kind of things are they looking to do?
Yeah, it's an interesting question. There's a lot more private companies than there used to be, and fewer public companies. And so I do think it makes sense to think about providing direct access to retail investors to private companies. And that's something that we're looking at and thinking about how we participate in. But some of these companies are huge. You look at the Stripes, OpenAI.
$500 billion.
Yeah, they're billion-dollar companies. And so I do think retail investors ought to be able to invest in them. And at the same time, there's probably people sitting at that company that would love liquidity for their stock position. So I think there's a market to be made there.
How much do you think that it's isolated in companies versus real assets? And I say that at a time when we're talking about the reindustrialization of the United States and the idea that there could be actually some oomph behind it for the first time in a long time. I mean, how much is that part of what you're looking to give access to clients?
Real assets?
Yes.
Well, I think real assets have been a great way to invest in our country. And the main thing we focus on is differentiating between productive assets and speculative assets. And I think real assets are productive assets. And so it's a great way for a client to get invested.
Are you concerned about, you keep talking about the coin and you're concerned about it, and actually the productive versus unproductive. Do you think that that's actually a point of concern right now in markets, the amount of involvement in the crypto space?
Well, I think crypto could end up being very, very valuable. And there's a role for it to play, and there's a role for tokenization and the blockchain. What's important to us is that investors, particularly young investors, know what they're investing in and know why it makes sense for them to be invested in it, and understand the difference between, say, an equity and a bond, which have some positive expected return and they're a productive asset, and just understanding the difference between that and a more speculative asset like art or baseball cards or crypto, where you don't know what the future return is going to be. It's not that we don't judge people's investments, and we can see a world where crypto is very, very valuable, but we want clients to understand the difference between those investments.
Do you think next year you're going to have more opportunities for either hiring or strategic opportunities because you think policy is clearer now out of Washington?
You know, what's driving our hiring is the growth of our business. We're growing at a really strong rate. We're seeing a lot of engagement from clients. Increasingly, they want advice from us. They want our help in their financial life. And because of that, that's what's driving our growth. It's not about what's happening with policy.
Can I just finish on the potential for a partnership on private markets? I wanted to ask you that. Is that something you'd consider, a partnership with another firm to offer that kind of access?
I think we would love to see retail investors be able to participate in the growth of private companies in our country.
So would Apollo. I've heard the same thing from them. I'm trying to make a market now.
And we have KKR on, firms like KKR on our platform.
Yeah.
And that our retail investors can invest in, and that's a great way to get access to private markets. They're experts. They started the market. They've been in it forever. That's a very thoughtful way for our investors to go be a part of private markets.
Stay with us. More Bloomberg surveillance coming up after this. As the record stock rally hits some skepticism following some big AI investment plans, Barbara Reinhard of Voya Investment Management remains optimistic, writing, "We remain overweight equities, have been all year. We remain overweight the US." Barbara joins us now for more. Barbara, good morning.
Good morning.
Let's start with that overweight. Let's start with why. What underpins that view?
Well, I think it's all been about earnings, right? So everything that you think about in terms of the equity market, yes, it's had a massive bounce off of the bottom, but more than 55% of it has been driven by earnings. Only 45% has been driven by multiples. As long as companies are delivering on their earnings, the equity market seems to be, poised to continue to go higher.
The earnings story for a handful of tech names has been absolutely phenomenal.
phenomenal. The CapEx intention spending plans have been phenomenal as well. And as Lisa was talking about just moments ago, this market keeps rewarding those spending plans. Are we anywhere near the limit of investor tolerance?
Well, I think you have to put it in context. A lot of people are starting to think about, is this like the late 1990s bubble where we had spent a lot of money on overinvestment in fiber, and fiber was being lit and there was dark fiber still to go. But you have to remember, many of the tech companies that were just propelling the market forward on the NASDAQ in the late 1990s didn't have the earnings power, didn't have the free cash flow power that the companies today have. The AI investment, I think, is just starting to scratch the surface. We see it on our teams that we are using AI to help us with repetitive tasks, to help us with quarterly commentaries, to help us with earnings calls. So we're seeing it lift our business in terms of efficiency and in terms of productivities per workers. It may take a while for that to flow through the economic data. We may see the productivity boom 5 years from now on AI, but we do believe it is indeed coming.
Do you believe it enough to wager on the broadening out trend, the idea that the tech advancements are not going to be isolated to a handful of large companies, but that there is going to be this groundswell of support for the equal weight?
Lisa, that's a great point. And I think you have to look outside of the U.S. to talk about that. So this entire year, the emerging markets had been lagging behind the U.S. And even coming off of the April bottom, a lot of global markets had come off the bottom, but the U.S. was leading the way. Just in the past 5 to 6 weeks, you've seen this big trend that the emerging markets are starting to outperform the U.S. But if you look under the hood, it's really emerging market technology stocks are outpacing U.S. technology stocks. It doesn't mean that they're not all going up together, but emerging markets seem to be taking the lead. I think in order to believe in a broadening out of the market, you need to see the Fed continuing to ease. You need to get past this inflation spurt, but you also need to get past this low firing, low hiring phase that the U.S. is in. There is a little bit of nervousness underneath the surface in terms of how long this can continue to go. We think that once you get to the beginning of next year, you've got the fiscal stimulus boost from the big, beautiful bill. You'll have the depreciation write down for companies. So you're going to have a much bigger fiscal stimulus push once you start to get to the first quarter of 2026.
This might be a difficult question to answer. And this was something I was thinking about yesterday. Is it feasible to see a broadening out in terms of which stocks are doing better and inflation coming down? And I ask this because yesterday in the PMI data, it showed that actually companies were having a harder time passing along the costs to their consumers. That means shrinking margins. That means less profitability. That means something for investors that's not very positive. So are these stories kind of in conflict?
Lisa, it's a great question, but I think you have to take a look not only at margins, but the level of margins. Margins are extremely high in the U.S. And yes, companies have not been passing on all the price increases from tariffs, but I would say there's always room for negotiation for those to continue to go lower, and that would be very well received by the markets. So I think you have to take these things in terms of context, in terms of if margins come down from 27% down to 25%, is it really that big of a deal? But it's a great question.
Barbara, you said you see productivity with AI actually being an enhancement. At the same time, you say we're in this low hiring, low firing regime when it comes to labor market. Do you see companies not hiring because specifically AI?
No, I think it's more companies are not hiring because of a lot of uncertainty, right? You've had a lot of potential shocks to the economy over the course of this year. You had the tariff-induced downturn in April, which was really significant and very severe. I mean, you had very deeply oversold conditions within financial markets. There were a lot of calls that the world was coming to an end, big rally off of the bottom. But I think that this low hiring, low firing is just a matter of companies saying, we need to get through to the end of the year to get some more visibility on earnings. But companies are holding on to workers. If they're holding on to workers, it's because their sales are in good shape, their earnings are in good shape, their profit margins are in good shape. So as far as we see it, the low hiring is a lot of uncertainty regarding the tariffs, uncertainty regarding where the Fed finally settles. But in the end of it, we don't see that this is necessarily the beginning of a labor market unwind.
But don't we already have certainty for the most part? The tariff levels are set. We know the direction of travel. We know the direction of travel of the Fed. What is so uncertain about this environment right now?
I think that when you're thinking about the tariff levels, there's been a lot of negotiating on them. They were set at very high levels. Then they got renegotiated down. There's always room when there's negotiations. You've got to think that is there potential that they're going to go lower if the U.S. hits much of a soft patch. Let's just say this low hiring, low firing starts to go into either an inflationary surge, or if you get into this environment where you have maybe the low hiring and the firing starts to go up, I think that the Fed and I think the administration would likely respond to that. They have a midterm election coming up in 2026. The clock starts actually this November, and they want an economy that is briskly growing for the midterm elections.
I think it's already started, to be fair. I was looking at the PMIs yesterday. Inventory levels not great, new orders not great.
Yeah.
I was hoping things would pick up. Don't see many signs of it. The ability to pass through high prices to consumers, but a pushback there too.
Yeah.
But consumer spending has been relatively strong, right?
It has been, but I'm just looking at the PMIs yesterday. I think there was a hope that in September things would pick up and reaccelerate. I just haven't seen that yet. I hope that it's backed up by the data points, just don't see it yet.
Well, I think the consumer has been acting like this. They kind of go through these spurts. They spend for back to school, then they kind of go into hibernation, then they spend for the holidays, right? So the consumer has been looking for a lot of deals for a long time. This has to, of course, think through this, this period of where you've got some uncertainty around inflation, and higher prices do scare consumers, right? They start to look for better bargains. They go for, off-label brands. But I would say once you start to go through for the holiday shopping, you may have a lull for October and November, but let's start looking at those kind of after Thanksgiving sales.
Stay with us. More Bloomberg surveillance coming up after this. Stocks rising as Alibaba becomes the latest tech firm to ramp up AI spending. Peter Tchir of Academy writing AI is only the second or third inning, maybe even the top of the first. The issue is whether valuations are in the eighth inning. Pete joins us now for more. Pete, good morning.
Yeah, good morning.
Hey, good to see you. Let's just talk about the spending plans. What's your reaction been to the news that's come from Oracle in the last week, from Nvidia in the past few days, from Alibaba from this morning?
It's all clear that spending is still going away. It's coming in. It reminds me a little bit, though, too, at some point, remember when you had to have a Chinese plan? And if you had a China plan, you announced your China plan, your stocks spiked 10%. So we're in that sort of moment where everyone who announces plans to spend is rewarded. And if you announce that you're going to spend $10 billion, your stock goes up $20 billion, why wouldn't you? So I haven't yet seen that change. I think at some point we're getting closer. People are starting to poke more holes in this. And separately from that, though, I am watching what Bob is doing separately, because when I look at everything that's going on in the world, trade, tariffs, etc., China has control over the rarest critical minerals. We have control over the AI chips and data. China's trying to work their way in. It's encouraging that they're using NVIDIA chips. But I think that's going to be a real battle line to be drawn.
Well, let's build on that. Do you think the US is at a disadvantage?
I think the U.S. has a huge advantage right now in terms of chips. I think China has this big advantage in terms of the processing and refining of rare earths and critical minerals. We're taking some steps, whether it's investments in ticker symbol MP. There's new noise about more investments of those sorts, whether it's antimony, lithium. I'm sure there's going to be enriched nuclear, enriched uranium investments. Those are the things that we're doing to try and defeat that. But that's a multi-year product. And then at the same time, it felt like China was going to be very easy to work with in terms of dealing with NVIDIA. They seem to be setting a line in the sand where they're going to be, we want to use Huawei more and more. So that's what I'm watching most carefully.
There's a lot to unpack there. You mentioned that, yes, the Chinese government has been pushing their tech giants to invest in domestic companies and domestic chips. And yet, what you just mentioned was Alibaba. Right. They're using NVIDIA supplies. Right. And they actually have a new project with robotics that they're also really relying on NVIDIA for their supplies. So how feasible is what the Chinese government asking for?
That I don't know, and I think maybe part of it's just a negotiating ploy, because again, everyone's now figured out maximum leverage, so you say these things and then you walk into a room with President Trump and try and get what you can. Having said that, China plays a long game, right? And they were nowhere in AI a few years ago. They are working their way towards that, whether it's a DeepSeek type technology, whether it's what the Huawei chips that are going on. So I would not completely dismiss them, right? They are starting this kind of steamroller effect. They're currently losing, but I think they plan to catch up, and we've got to be very cautious of that. I do think this is a big win for NVIDIA. I think it's awesome for us, but this is not given. I think if we take it for granted that it's going to keep occurring, that's the risk.
Going back to your initial point, the idea that we're in the 8th inning, even though we're just in the 1st or 2nd inning when it comes to the actual production, 8th inning evaluation, at what point does it get too far ahead of its skis?
I think it's when you start seeing these announcements and the stocks don't pop, right? When someone announces a 20 billion spend and their stock goes down by 30, 40 billion, then you're like, okay, people are now tired of this. People have kind of sensed the valuation. I think
I'm laughing because we had that for a hot second and then that reversed again, but carry on.
And the other strategy that has worked so well is momentum, right? Momentum tends to work. These have been big drivers of momentum. If momentum starts turning around and you see the CTAs and people get forced out of trades, but we're nowhere close to that, right? Every dip gets bought right now. I'm not seeing what's changing that. The one thing that I found both encouraging and maybe worrisome for big tech is the Russell 2000's finally outperforming. I think, not by much. I think it's up 3% in the past 5 days. NASDAQ 100's up 1%. But that's where I'd like to see the shift, is to a broader expansion to more stocks performing well.
Peter, I'm glad you brought up the rare earths issue, because Representative Adam Smith was in Beijing yesterday saying, I don't think we resolve that. Is the U.S. potentially willing in these trade negotiations to give up other issues they care about because they are so desperate for these rare earths?
I think we might have to at this point. And again, I think we've got to be really careful. It's not the rare earths and critical minerals themselves. It's the processed and refined versions, right? We could go and buy rare earths, critical minerals on the open market. Where are we going to get the processed and refined versions? China controls about 90% of that. And so I think that is very true. And I always go back now to COVID. And I think it was the Whirlpool CEO said a washing machine that's 99% done is not done. And I think that's the problem with these rare earths and critical minerals. They may only be a small component of each product, but they are literally critical. No pun intended, and that's the issue. So we are going to have to give in until we build out our own industry.
What do you think it is that the Chinese desperately want that we're going to have to be willing to give in?
I think it's probably going to be chips for now. I think they, as much as they say they want their own business, they're going to try and get as many chips in the door they can while they want it. And I think they're also just buying time. They're playing this while they try and solidify their trading relationships with other countries, right? While we're trying to sell chips into the Middle East, I'm sure Huawei right now is trying to sell chips into the Middle East. So some of this may be just a delay game by China until they get. I think time is on China's side if you're China, because they watch the U.S. We're very distracted. We have so many things going on internally that they can just keep their machine moving. And if they can distract us, that's fine by them.
The White House is making a move. MP Materials being the blockbuster one of the last year or so. And then you've got the potential for an equity stake in Lithium Americas. That crossing the Bloomberg this morning. The team has been reporting on that. How are you thinking about the prospect of increased intervention, an increase between public-private partnership going forward from here?
Well, my starting point would be, I think I mentioned this weekend, it's you may or may not like what's going on, but you certainly have to trade it. So if you're investing in this market, whether we like this intervention, whether we like this ability to play kingmaker, I'm not sure that's the right direction. Having said that, in the old days, right, the CHIPS Act, right, it just gave grants, but the grants were tied with policy strings. So I don't know, maybe we're better off investing. It's tricky, but I do think right now you're supposed to be scouring the universe for $5 to $10 billion companies or smaller that do things. So I've been involved myself directly in enriched uranium. I think there are other products like that. They're going to take off because this government needs to jumpstart it. And again, if you go back to what they did with MP, it was a relatively small investment. I think it's kind of the tip of the iceberg what we might be able to do out of a sovereign wealth fund, but they also help provide 1.1 billion of loan guarantees, right? And that, to me, that's how we spur this growth. So if we go down that path, that's how we have a chance, but it's still a 3 to 8 year process.
This is the challenge, Pete. If you are a child of Reagan or Thatcher, you've got to park your feelings about this and let it go. This administration wants to pick winners. Are you saying that when they pick winners, you want to go along for the ride?
I think so. I think, to me, in hindsight, it wasn't surprising at all. And I owned Intel. I think I talked about owning Intel. And not a shock that Trump would maybe ask NVIDIA to get involved because Trump wants Intel to do well. Like, Trump likes winners, right? That's all he's ever done. He's going to back winners. He's in a strong position to push these things. So whether you like it or not, I think you have to accept that this is the current administration's view. These things are going to get support. So you want to look for those. And you've seen so many stocks take off, but I think we're still early stages. And this is all without an official sovereign wealth fund, which I think something that is coming down the pipe for that before the year end.
This is something that David Rubenstein yesterday of Carlyle was talking about, that essentially that is the model that we seem to be following with the stakes that we're taking in a number of companies. And it seems like the United States is moving from fiscal dominance, as sort of the backbone of the U.S. economy, to something that looks more like a sovereign wealth fund, and exactly what that looks like still remains to be seen. I just wonder how that changes investing, whether that shifts some of the macro investing landscape and shifts it over into deep value, looking for these specific sectors, looking for exactly strategically what makes sense. It's a very different framework of investing.
Yeah, one of the things we're trying to do is look at AI and look for companies that have been most impacted by regulation and say, okay, if you've been heavily impacted by regulation, is that an area we can get deregulation? I think finance companies are doing very well, right? I think people are looking forward to what can be done on this. And then I would say this is global, too. I know, the UK Prime Minister didn't completely agree with Trump, but I think this whole concept of production for security is global. And every country has to be thinking, what can you produce at a minimum level? It doesn't have to be fully. You need to make sure that you have energy. You need to make sure you have a chip industry, right? England wants to be a data center capital of the world, but they don't produce any energy and electricity. How are you going to do that?
Not exactly the traditional way of building a sovereign wealth fund, is it?
No.
This isn't typically how you go about doing things.
Well, not especially through a back door where people don't understand what the parameters are, or exactly what's going to go in, or exactly how big it's going to be, or exactly how the revenues are going to get distributed afterwards. Look, there's a lot of question marks around this. But fundamentally, from a philosophical perspective, it seems like maybe the limits of fiscal dominance have been reached, and people are asking for something else as a tool of national security. And the idea of taking stakes seems to be it, whether you agree with it or not. And I think that that's a really interesting change in the investing landscape.
They haven't outwardly stated they want to do this sovereign wealth fund, but it's obvious everything is about national security. MP Materials, when it comes to Lithium Americas, when it comes to Intel. This administration doesn't like grants. They don't like loans. They want outright equity in a company.
Big final word.
Yeah, and I would just add that, we're looking at these companies that we need to jumpstart, and people are worried about if everything's just done via executive order, does it get overturned with some new administration? I think these stakes change that. It makes it harder to overturn some of the progress that gets made. So I think that might be kind of the secret sauce here, is by investing, owning, giving the American people this, it lets people push forward on deregulation and assume it's going to stay longer than it might otherwise.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to Nathan Sheets, Chief Global Economist at Citi, writing the following. US firms appear to be absorbing 60 to 70% of tariff costs today. However, we doubt that this will prove sustainable as a longer-term strategy. Nathan joins us now for more. Nathan, good morning.
Good morning.
Good to see you, sir. Which way do you think it breaks if it's not a long-term strategy?
Well, I think that the firms have been able to absorb as large a share of the tariffs as they have, largely because they front-loaded inventories and they're drawing down those inventories. But I think over time, they're going to have to pass it through to consumers. And I think we're going to see it in the CPI. To the extent that that doesn't happen, then firms' margins are going to be compressed, and they're going to be thinking about, how do I cut costs? And then that's bad news for the labor market.
So the question again, which way does it break? Is this an inflation story? Are they passing it on, or a labor story? Well, are they cutting cuts?
The Fed has cast its vote on that one. This is a tough period. The economy is absorbing a stagflationary shock. The Fed's got to choose between its mandates. And Jay Powell's telling us, well, it's painful, it's complex, it's difficult. But on balance, they're signaling greater concern about the labor market.
The market agrees with them. The market agrees this is the prudent route to take, because essentially people are not pricing in a real reacceleration of inflation. Do you think that's correct?
I was very concerned about how the long end of the curve was going to respond to signals of Fed cuts. And as you say, the long end of the curve has responded very well as the Fed has shifted more in the direction of an easier monetary policy. And of course, the equity market is thrilled about an easier Fed. So at least so far, it very much seems that the markets are with the Fed, and they also, at least the preponderance of investors, are more worried about the labor market. One other angle on this that's helpful is that in the Fed's view, and I'm persuaded they're right, they see the stance of policy as still being restrictive. And so what they're doing is not providing outright stimulus, but they're just reducing the constraints on the economy as associated with monetary policy.
As an economist who's tasked with trying to put together all of these disparate trends and themes, How do you understand the moment we're in? Is it disinflationary? Is it reinflationary? I mean, I've heard an argument on all sides, and every time anyone makes an argument, I'm like, yes, you're right. And they're always the opposite sides.
Well, for the United States, I think it's stagflationary. And that's the reality of these tariffs. They're putting upward pressure on prices. They're putting downward pressure on real incomes and spending in the economy. And the Fed's trying to react to that. Now, for the rest of the world, the tariffs have a different implication. For the rest of the world, they are an adverse demand shock, reducing demand for exports, putting downward pressure on wages and prices. So I would say disinflationary for the rest of the world, stagflationary for the United States.
But in your global economic outlook, you talk about how consumers and companies were actually able to absorb it pretty well. Do you think that story is going to change?
So far, absolutely. Particularly here in the United States, we've seen resilience. Now, part of that I do think is a transitionary phase, and specifically, what's happened is the tariffs have come on gradually. And as we've seen the tariffs coming on, we say, well, prices are going to be higher tomorrow. What do you do if you think prices are going to be higher tomorrow? You buy more today. And so the economy has been supported through the first 6-8 months of the year through a front-loading cycle. That's now gradually abating. And when you get to the other side, all that stuff that we bought during the first half to get ahead of the tariffs, we won't be buying during the second half of the year. And that's where the payback comes in. We'll see the higher prices. And I think at that point, we are likely to see, I don't think we're going to see recession. I don't think we're going to see a collapse in economic activity, but a further slowing in the pace of growth is our expectation.
If inflation, though, is a concern pushed down the road then in 2026, what does that mean when we have a new Fed chair that is going to be very different than how Jay Powell views the world?
We are learning about how tariffs affect economies in real time. And for me, one of the big surprises has been that the pass-through of the tariffs into inflation has just been a lot slower than what I'd expected. The corollary to that is, we'll probably still be talking about tariff pass-through into inflation during the first part of next year. And it may be an issue even in the spring when we get a new Fed chair. Now, there's a lot of issues surrounding where a Fed chair appointed by President Trump may ultimately go. But managing the fallout of the tariffs is likely to be one important issue that they're struggling with.
When do you begin to ignore Chairman Powell?
I think he's got his hands on the steering wheel.
For how much longer?
I'm gonna argue until he leaves the Fed's building. I think he's still going to be the one who is largely going to be dictating the direction of policy, as long as he's chairman of the Fed. And I think part of that is he's got credibility with the other members of the committee, and I think that gives him influence and the capacity to shape policy.
Can he shape markets? You can at the moment, of course.
Yes.
But once we get closer to May, the reason I add this, as you know, the policy is not the interest rate, it's what happens in the market.
Yeah.
That we all understand that. And at some point later this year, there's going to be someone else who gets to say, you know what, I'm next. Yep. And his views, or hers, who knows, might carry more weight than Chairman Powell's.
Yeah. To the extent that policy is influencing the economy today and over the near term, and as you say, the horizon where his policy will be relevant is shortening and will continue to shorten as we approach May, then we're left to speculate on what a next Fed chair may do. But I think in terms of setting the table and determining where rates are, I think Powell's in control until May.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.